Hey everybody, we are going to talk dividend stocks today. Tyler Crowe is joining me. We have very different views on what the best dividend stocks are, so we're going to bring both of those to the table today. Um, Tyler doesn't, kind of rolls his eyes about some of my stocks, but I like him anyway. So without further delay, please check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now from our sponsor, the Motley Fool. It's the best way to support this work we're doing on YouTube. Again, fool.com/Frankel. So we're going to talk about two dividend stocks that each yield about 6% or more, rounded, and why we like them. So Tyler has one that I'm really interested to hear him talk about because I've been out of the energy space for a while. I haven't invested in energy stocks in quite some time since I got burned by one that I always like to poke Tyler about. Um, but I feel like it's time to move on. So I want to hear some more energy opportunities. Tyler, which one are you looking at right now?
So yeah, I'm looking at Cheniere Energy Partners, and I want to be clear here. This is a master limited partnership. This is not a common stock. So if you are looking for something to hold in a retirement account, this is probably not for you because master limited partnerships tend to create a lot of tax headaches come tax time. If you own them in a retirement account, it's best to just own them in a brokerage because they're already a tax advantaged kind of corporate structure where they pass, you pay the corporate taxes for the company, your proportion of the ownership of the company. So just a little note as we start this conversation, because I think anybody who puts an MLP in their retirement account has a tax accountant that is furious with them come tax time. So I wanted to start with that. But the reason that I like this company specifically is because it is a stable dividend payer with a lot of kind of visibility into its revenue with a nice looking kind of upside in the next couple of years. Cheniere Energy Partners is a master limited partnership subsidiary of Cheniere Energy, and the partnership specifically owns the Sabine Pass liquefaction facility. We call it SPL from here on out. It's a 30 million ton per year liquefaction facility that more than 85% of its entire production capacity is contracted out on these 20-year take or pay contracts where basically it's saying like, look, you signed up, the customer signs up for 20 years, they're going to buy this much every year, and even if they don't take delivery, they still have to pay for it. And on top of that, the contracts are set in a way that like there's really no commodity risk for Cheniere specifically. It's basically a liquefaction fee, and the person who buys it has to pay the commodity price. So you have this very, very stable volume kind of game where for like for the next 15-20 years is kind of locked in at this things with a little bit of upside or downside on that last 15%, which translate into something that's very easy to manage from a dividend standpoint. It's like, look, we know pretty much for the next 15 years how much cash is going to come in the door based on these contracts. And with that little, sometimes we can, when like say in 2022, when natural gas or LNG prices spiked because of the war in Ukraine, there was, they passed out some special dividends. And so all in all, like if I'm looking for a reliable dividend that it's probably not going to grow a lot for the next couple of years or so, I think this is really attractive. But the reason I said it has kind of this growth kind of catalyst down the road is they're planning an expansion project for this facility specifically. And they're anticipated in 2026 to give it the final go. And this is a 20 million ton per year expansion project. And like I said, this was a 30 million ton per year facility to start. So we're looking at, 66% growth on top of what it already has on slate. So if you're looking at that and you say like, well, in the next 5 years or so, when this thing is actually built out, that's a pretty significant uplift on top of that. And the way that the dividend is built, they can pay for most of the facility without taking on significant amounts of debt currently. And, at current rates, they can kind of pay down a little bit of debt. So a little bit more cash can go towards the dividend over time. So all in all, it's a very, very like stable revenue with this nice kind of upshot in the next several years. And at current rates, it has a dividend yield of about 5.9%. So you're getting a pretty good payment right now with a little bit of upside on the way, and then potentially a very large catalyst coming in a couple of years. It's kind of the reason I like this one. It's probably not the most conventional pick today, but I think that's part of the reason why I like it.
Yeah, I like that one. So I'm going to talk about one that's familiar to the two of us. That's EPR Properties, Real Estate Investment Trust, and I think that right now could be kind of an inflection point for the company, and I'll tell you why. So EPR, they are a real estate investment trust. They specialize in experiential properties. I think the E actually stands for entertainment, but they're experiential properties. And they have a 7.6% dividend yield. They're one of the few monthly payers. Um, Pretty low payout ratio. So the payment's well covered. The biggest kind of Achilles heel for this company is that the biggest property type it owns is movie theaters. Now, there's a few things with the movie portfolio that are worth pointing out. One, the company's done a good job of reducing the kind of junk in its movie portfolio. It's kept its best theaters, which the bulk of EPR's theaters are these big megaplexes with the big reclining seats, lots of food options, the modern theaters in busy areas that do well. It does own some vacant, kind of crummy movie theaters. Those are the ones it's selling, taking a loss on some of them, but selling. It's successfully reduced movie theaters from about 50% of its rental income a couple years ago to 36% now. That's a pretty substantial reduction. So it's a lot less dependent on movie theaters than it was. So that's one. Number two, you probably heard that Regal Entertainment went bankrupt a year or so ago. They filed for bankruptcy and went through bankruptcy, and that's true. And their EPR's second biggest movie theater tenant, next to AMC. That lease was resolved kind of favorably for EPR. They did a master lease that covered the good Regal properties. They're getting rid of the rest of them. And one thing I kind of like is that there's a performance-based component in the leases that gives EPR more money if the theaters perform well, like box office revenue wise. Um, so I say that to kind of pivot into the fact that box office revenue is performing a lot better than expected. The Thanksgiving weekend movies it was the busiest Thanksgiving weekend in movie theaters ever this year. I took my kids to see Moana 2 last week, and had to wait 20 minutes in line to get popcorn because it was so busy. The movie people are going back to the movies. It's not the dead industry that a lot of people think it is, and that was a Regal theater, by the way. Um, September box office revenue, and this is before the big blockbusters came out, was up 25% year over year. A lot of great titles coming out in the December period. So I think box office revenue is doing a lot better than people thought it would. EPR could be a big winner of lower interest rates. They recently got a new $1 billion credit line, and Tyler, when we've talked about this before, we've said that yeah, they have $1 billion of available credit, but they're not allowed to use it because of their debt covenants and things like that prevent them from borrowing. Now they got those debt covenants changed so they actually could use it if they want to. They've said that they are not really going to put their foot on the gas until cost of capital looks better, meaning when interest rates come down, um, or when the stock price goes up, so they can issue equity to fund growth. But I think that date is approaching quicker than people think. Um, if the Fed keeps cutting rates, I think the cost of capital could get very favorable, and EPR is going to find some deals and continue to grow and get back to where it was kind of before the pandemic sent the movie theater industry into a tailspin. So I think this could be a nice opportunity to add EPR if you've been on the sidelines. I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with the Motley Fool to bring you 10 stock picks from the popular product Stock Advisor. Stock Advisor has beaten the market by nearly 5 times. So go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 767% as of July 5th, 2024, and are measured against the S&P 500 returns of 163% as of July 5th, 2024.